Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Today we're talking to Nick Chaplin from Seed Funds Management. Last year, APRA made some significant changes to the way hybrid bank capital was organised and available. Today we welcome Nick back to give us an opinion and the results of what he thinks happened in the market. Welcome, Nick.
Hey, Chris, nice to be here.
So good to see you back again. You know, it's been a few months now since APRA did what a lot in the industry thought was not the right thing to do, in spite of the fact that APRA claimed that it was supported by the industry. What's been the result in the market on bank hybrids?
Well, you're right. It's been about 3 months now, and we've had obviously the Christmas New Year break since then. So it was fairly slow start. On the 9th of December, they came out with the confirmation that they were going to phase them out between 2027 and 2032. And the market has remained fairly calm about it. We've seen volatility in the listed hybrid market slightly more than the wholesale market, even with the volatility coming from the tariffs, etc., more recently, and storms, etc., in Queensland. But they've held their ground fairly well. We've seen margins hovering around between 3 and 7 year terms to call for these listed hybrids at around 200 basis points over the 90-day bill rate. And that's been fairly consistent, at times individual ones moving wider or tighter. The thing that I have noticed is that the spread between the bid and the ask is widening on more than usual. So that's a form of volatility, Chris. And that's because people are forming their decision on whether, have they gone to their tightest point? Should I take my profit now? Is there a difference between these instruments and something more senior now that the call risk is taken out? If I don't believe that the banks are going to get into any trouble, why is that any different from something more senior? So they could therefore tighten. So all of these questions haven't got strict answers, but people are forming views.
So APRA did this ostensibly to make the banking sector stronger, but you could argue that Australia has one of the strongest banking sectors in the world. How have investors been impacted? Are they better off or worse off as a result of this?
Well, I think when you look at the type of investor, despite what the regulator, APRA, and to some extent for the last 10, 15 years, ASIC, has been criticising the market on, is the fact that they believe the investors didn't understand the instruments. But what the investors are doing is actually making a view, or taking a view, on the banks and the strength of the banks, their capitalisation, their liquidity, the way the balance sheets are managed. They're taking a view that the banks are much, much stronger than they used to be, and they're right. They are. APRA has done a very good job since commencing this work in 1998. So I think the error has been to think that the form of prudential regulation that was happening, particularly in Europe, where you've had failed banks, in the US, where you always will see failed banks. You're seeing 4 or 5 a year, really. You don't hear about them all the time. Credit Suisse was a major fail from the Swiss regulator, but meanwhile, over those 25 years, APRA has strengthened the Australian banks. And Australian investors, particularly individuals, self-managed super funds, wealth firms around the country, have become very comfortable with hybrids and the strength of the banks. So they're buying them on the basis that I don't believe the banks will fail. Yes, there's a chance it could, and if it does, we'll get nothing or something less than $100, but we don't think that will happen. So that wasn't taken into any consideration, or it's seemingly not taken into consideration by APRA. And consequently, I think by taking this sliver, and it was a sliver, of capital out, you are effectively downgrading the level of safety for depositors. You're downgrading the level of safety, particularly for investors in subordinated notes. Standard & Poor's have already said there's a risk that we will downgrade Tier 2 subordinated note instruments because this amount of capital is coming out from underneath them. So a bit of a mountain over a mountain instead of a molehill here for the regulator.
So the cynic would suggest that this was a way to reduce franking credits or remove franking credits, which of course the government tried to do, or when they were in opposition tried to do. Do you support that view?
I think there's some arguments to be made there. It was worth about $1 billion in tax credits a year for the amount of hybrids that were out there. That's valuable, especially when you're looking to put, as a government, put that money elsewhere. So I think there's some validity to that, Chris. It can't be proven, but anyway, it's the decision's been made, and I don't think, even if you had a change of government and the government was fully involved in this decision or influencing it heavily, that a change of government would make this go away. I think the decision's been made and we've got to live with it.
Okay, so what's done is done. Let's look forward. For the investor, what are the options now? I mean, it's not as if the market for your type of fund has disappeared. What's changed? Obviously, aside from the fact that these bank hybrids won't be available going forward.
Well, certainly there won't be any new bank hybrid issues. That's been proven by ANZ and CBA now announcing that they're calling but not reissuing. That will continue to Westpac's deal in August, Macquarie's deal in December. So they're going to just come off like clockwork over time. There was a risk going around. People had felt that because of the expense of these issues, and a good example is the Macquarie PF issue, MQGPF, which was issued in May of 2022, runs up to 2029, 7 years. That is paying a margin of 3.7% over the 90-day bill rate. In 2 years' time, it will only count as Tier 2 subordinated notes under APRA's rule change. So consequently, you're paying more than 2% more for that sort of capital than you should be. So the risk being, Macquarie used it just as an example, but anyone could approach APRA and suggest, well, you don't like us paying too much for this form of capital, particularly if you can get it cheaper elsewhere. Can I call it, please, under a regulatory event? APRA has made it, and this is important for investors, APRA has made it very clear in their statement in December that they want an orderly phasing out of Bank Tier 1, with the call dates occurring naturally at the dates that have been planned already. So they have the final say on whether these issues are called, and they certainly don't want any adverse outcome for the market or investors. That tells me, if you read between the lines, that they're not going to allow early calls, even with those expenses, and the fact that the hybrids will now be classified as Tier 2 from January 2027. So I think we are in for an orderly exit, and consequently, for anyone who feels that the banking industry is sufficiently strong and that defaults may not happen, not suggesting that this is the case, but they could say, well, they could go tighter, because if the default's not going to happen, the call risk is gone, you're left with just payment of the distribution risk now. And that's for the market to discern whether that's the case. But certainly at the moment, the margins are holding up.
And Nick, how does it change the way you manage the fund and what you invest in going forward? Does it really change much? And if it does, how significantly?
I don't think it's a significant change, Chris. The hybrid income fund has been more than 50% subordinated notes for some years now. We saw benefits in the diversification as we were growing the fund for liquidity purposes. The market for subordinated notes is vastly more liquid than the listed hybrid market, and senior is, multiples of that liquidity. So we've increased the liquidity on the fund significantly in the last few years. We're about 64% subordinated notes in the fund as I speak to you today. We're about 25% Tier 1 or A Tier 1, additional Tier 1, and about 10% of that 25% is unlisted. So we have significant diversity already. We will continue to take advantage of primary market in Tier 2, secondary market in Tier 2, these subordinated note issues. As new money comes into the fund, we're putting that into senior bonds immediately, so there's no drag from cash, and then moving it down structurally into Tier 2 and Tier 1. The insurers and the non-banks can still issue. So we'll see what APRA does with that over time. Even though that's only 10 to 15% of the market maximum, we'll still take advantage of those transactions. There's more diversity coming into the subordinated note market. The smaller mutuals are starting to issue there more, and they're strong in terms of capitalisation and balance sheet management. Very sticky clients. So we like those opportunities as well.
So over time, your funds produced way above the benchmark performance. But do you see any change that's going to result from this that's going to affect returns to investors?
I think you've got to realise that if there's less primary market hybrids there, which it's basically gone now, you're going to be left with only trading in the secondary until 2032, and between 27 and 32, or any time from now, the banks will issue more subordinated notes to replace what comes up. So CBA have just announced on the 3rd of April their CBA PG deal will disappear from the screens. That's over $1.3 billion. And most of the banks are a little bit over capitalised, perhaps Bendigo's not. So CBA is probably okay. But you will see as they come off, they'll start issuing a little bit more Tier 2 to offset it, because that's what APRA said you can do. That does not have to be issued in Australian dollars. So I think some of this money will be replaced offshore for diversity purposes for the banks. But essentially investors will have to get used to the fact that there's going to be, if you think offhand that senior's about 5%, Tier 2's about 6%, Tier 1's about 7%, the hybrids, you've got to start thinking that the proportion that's going to be in that 6 and 5 is going to be more than the proportion that's in the 7. So yields have to go down. If the 90-day bill rate continues to fall, we've only seen that one drop so far in February. People are arguing maybe 2 more at the moment in this cycle. It's not too much of a drop, but you will get a drop as Tier 2 replaces Tier 1. So it could affect yields by 0.75% over those 7 years, depending on where that 90-day bill rate goes. And we're planning for that already.
But this is also in a falling interest rate environment, and we're yet to see whether rates actually do fall that much more, how inflation is going to run out, especially with turmoil overseas. No one's quite sure what's happening, thanks to sort of volatility and uncertainty in the US. But in a falling interest rate environment, the option is still to get 2 or possibly 3% above the cash rate or the bank bill rate.
Absolutely. I mean, we've been planning offhand, it's not a PDS type target, 250 over the cash rate, but we've been delivering more like 400 over that period. So our aim is to continue to do that. I think one good way to do that is through use of the primary market. There are new issue premiums in those sorts of instruments. Every fund manager that invests in fixed income should be looking at that option to make use of the primary market and the new issue premiums. There are vastly more primary issues of subordinated notes and senior notes than there are listed hybrids. So that opportunity is a straightforward one for us going forward. But we're always still conscious of the relativities between senior Tier 2 and Tier 1, and also constantly looking at the research that comes out on their announcements, where they are in capital. You've got to be looking at every nuance, Chris, and we don't shortchange ourselves there.
Nick, it's always fascinating to talk to you. It's a very specialised area of the market that needs your level of expertise and experience. Thank you for giving us your time today. We look forward to speaking to you again soon.
I'm very grateful for the opportunity. Thank you, Chris.
Thank you, Nick. Thank you, and we'll look forward to speaking to Nick again at some stage in the near future.